find out from this press release that we're handing out right now, the IMF board met yesterday and completed the 7th review of the standby arrangement that the country has with the IMF. So that means that in the next few days there will be a disbursement of about $427 million that will be disbursed to Sri Lanka's central bank. This was the 7th review. This brings our total disbursements up to a little over $2.1 billion. There's going to be an 8th review. That will happen in a few months' time. And that will take us up to the total amount of $2.5 or $2.6 billion. The press release goes into some details. I think, as you know, we are fundamentally very optimistic about Sri Lanka's prospects over the medium term, and we always have been. Over the second half of last year, we had some concerns about the policy mix. We had some concerns about the pace at which reserves were being drawn down at the central bank. And on account of that, we didn't move forward with the program for some time. But at the beginning part of this year, the authorities, central bank and government, took some very decisive steps to control the current account deficit and to make sure that the growth in this economy was going to be sustainable. And I think that's really a theme that I want to focus on. That we are very concerned about making sure that the growth we've seen, the good progress we've seen over the last couple of years, could be sustained over the medium term so that the welfare of the entire country can be continue to increase. We're really quite positive that the steps that they've taken are in the right direction in terms of getting the current account under control and laying the foundations for maintaining that growth over the medium term. And it's on account of that that we thought we'll go ahead with this review, and the board endorsed completion of the review. Investors who may get worried by movements in the rupee. So that perhaps was the rationale. I think our view throughout was that it would be good to take measures not just to finance the current account deficit, but to bring the current account deficit under control itself. Because capital flows are difficult to mobilize. They may take more time than required. And I think that's basically what we've seen them doing right now, taking firm steps to control the current account, while at the same time continuing these strong efforts to bring capital in from overseas, and that's appropriate. And we've seen a lot of success in the last few weeks even on that score, with money coming into the stock exchange. This a miss of the net international reserves target at the end of December because they were running down reserves. But what we've seen now is that they have taken very substantial corrective actions to get the ship back on track. So yes, there was a loss of reserves, but now we feel that with these policies, the current account deficit will be reduced, that the need to supply dollars into the market will be reduced, that the reserves will be preserved. And it's on the basis of that corrective action that we said, okay, we can waive that target for December and move forward. There was an issue definitely that credit was growing faster than expected. Credit to the private sector did grow at about 34% last year, and I think part of that went into import growth. That was part of the reason why we had the current account deficit widening last year. And that also is precisely why the central bank, when they introduced these measures in the beginning of February to control the current account deficit, one of those measures you would have seen was a tightening of monetary policy, a rise in interest rates, an increase in interest rates by 50 basis points, and then an imposition of a credit ceiling on banks, precisely to get that under control. This is an issue, I think, that got a lot of confusing press coverage in the past. It's actually quite simple, and nothing has changed since when the program was approved. The basic thing is we are charging an interest rate that, it's a floating rate, but it's based on LIBOR, but basically it is around 1.1%. That 1.1% rate applies up to a certain amount of lending. Once you get above a certain level, which in Sri Lanka's case is about $2 billion, then any excess over that will attract a 200 basis point surcharge, 2% surcharge. So that is to say that right now, out of the $2.13 billion which have been dispersed, $2 billion are attracting an interest rate of 1.1% or thereabouts, and the $130 million extra is attracting an interest rate of 3.1%. Now, the issue of the recent taxes on vehicles and other goods, that actually is something that we didn't discuss with the authorities at all. We were not expecting it. We were happy to see that it shows that they are taking this balance of payments issue very seriously. They are very responsive to that idea, and they're trying many different policy tools in order to address the issue. So we were happy about that. I think our own view probably is that adjusting tax rates is not always the most productive way of addressing this kind of problem, because yes, it is certainly true that the rise in vehicle imports was part of the widening of the balance of payments deficit last year, widening of the current account deficit last year. But whether it's appropriate to do selective tax increases in order to combat that rather than more generalized instruments that are less discriminatory and apply more across the board, whether that's the appropriate approach is something that we had some concerns about. For us, we would probably use more broad tools. One thing that we've talked about in the past is the need for monetary tightening. I think there's been a policy rate hike of 50 basis points. We've seen market rates rise by more than that. Could there be a case for raising policy rates further to match what we've seen with the market interest rates? Those are more the lines that we are thinking. I think in 6 to 12 months we're still looking at balance of payments issues, and can we make sure that basically consolidation of this new policy regime where we have flexibility, where reserves are being conserved, being kept for a rainy day. I think making sure that that sort of policy is maintained is probably the focus. Wanted more time in order to evaluate the change. We've seen a very different policy regime, so let's evaluate how it operates and what kind of effect it has on the economy over a slightly longer period. It's not like we're delaying by very much. It's a reasonably short period, and it actually is the normal schedule. Usually we've been having quarterly reviews, and that's what we're doing.
This country will recall that we said the recent depreciation of the currency, the increase of interest rates, and the upward revision of energy prices, both in fuel and electricity, all of those were in order to satisfy IMF conditions. The government vehemently rejected that. They said it had nothing to do with the IMF. But now, based on the letter signed by Niwad Cabral and Geethanjana Gunawardena, they have admitted that they did 3 things to fall back in line with the IMF's conditions so that they could request for the IMF to release the suspended tranches totaling $800 million. Now what does it say? It says, 1, we depreciated the currency. 2, we increased the interest rates. 3, we increased domestic petroleum and electricity prices. So they have admitted to it. We continue to warn the government that by trying to artificially control the macroeconomic variables, interest rates, exchange rates, that they were creating a huge problem for themselves and for the people of this country. Those warnings were dismissed, but some months later, people realized that obviously the policies of the government were absolutely incorrect. They are now saying the increase in duties has nothing to do with the IMF, that it is because there is congestion on the roads. Right? And I want to tell you, again, that also is a fabrication, because the objective of the government is to somehow reduce imports. And in order to reduce imports, increasing interest rates, depreciating the currency, increasing fuel and electricity prices, and obviously increasing import duties will all contribute towards reducing imports, so that the net external reserve position of the central bank, which is a technical term, which is the condition that IMF has laid down on Sri Lanka, can be met. It doesn't have a policy of its own on its domestic economic affairs. There is no proper policy. Whatever the IMF says, they will do. Then they will try to renege on the agreement and do what it wants to do. Then it will hit a brick wall. Then it will go begging to the IMF again. Then the IMF will say, do something else. Then they will say, thank you very much, sir, come back and do that. After a while, they will renege on this and do something else. They will go hit another brick wall. We are only going sideways. We are not going forward. 8% growth is peanuts. Because if you look at the studies done by IPS and the others, they said 2% of growth was removed because of the war. So if there was no war, you should anyway have an additional 2% growth. So 6% normal growth plus 2% is 8%. So now UBS and others have indicated that the growth will fall to 6%. So if you remove the 2% from the 6%, you are down to 4%, which is going back to the pre-1977 era, which I looked up and found that 80% of the countries actually release it to the public. 80+% of the countries. Sri Lanka is a minority in that. Since 2007 December, we have not released the IMF Article 4 consultation report to the public. For 2008, the government has to release it. For 2009, it has to release it. For 2010 and for 2011, the government has to release the Article 4 consultation reports. We urge the government to do it immediately. So at least then the public will know the real situation of the economy. I mean, here is a generalization of the government wanting to hide the truth from the people, nothing else. In this country, we don't have the right to information. If we ask questions in Parliament, these questions are postponed over and over again. We request the government to be transparent, particularly replying Asanta's question about transparency and letting the public know about what is happening. The EPF hasn't still released its 2010 report to Parliament. Yesterday I saw the President telling department heads, you do your job, have good governance, I will deal with the international community. Right? It hasn't still been released. So this is not an isolated case. This is the way in which this government wishes to engage itself in governance.